Well, everybody who's concerned about saving for retirement is paying attention to the tax proposals making their way through Congress. But there are some hidden taxes that are not getting a lot of attention. Our Robert Frank, though, has the details.
Congress has been very vocal about how they would like to cut taxes as part of tax reform, but they've been more quiet on who could potentially get tax hikes. Here are just a few of the hidden tax increases in the House and Senate bills. Now, the Senate bill includes a tax hike on certain stock investors through what's known as first-in, first-out accounting. The bill would prevent investors from lowering their taxes by choosing the specific shares of stock that are being sold. Now, usually investors sell the most expensive shares they purchased or those that have lost money to get the tax write-off. The bill would force them to sell their oldest shares first, known as first-in, first-out sales, no matter what the purchase price. Now, this takes effect in 2018 and would raise a projected $2.7 billion in revenue over 10 years. Initially, the mutual fund firms like Fidelity were also subject to the tax, but after lobbying last week, they are now exempted. Now, another hidden tax hike, tuition waivers. The House bill would label as taxable income college tuition waivers. That's when a university waives their tuition and sometimes provides a stipend for grad students who work as a teaching or research assistant. About 145,000 grad students and 27,000 undergrads are awarded the waiver every year. They would now be taxed on income they don't actually receive. And people who collect art, cars, and other family treasures may also get a possible tax hike. The House bill does away with what's called 1031 swaps, or exchanges in kind. That's when someone sells an asset but postpones the capital gains tax if the cash is used to buy something similar. Now, art collectors use this a lot to sell one painting and buy another without paying a tax. So do buyers of airplanes, tractors, and sometimes cars. Sotheby's mentioned it in their earnings call as a possible negative for the art market. But Congress specifically carved out one group that will be allowed to keep using the tax loophole. That's real estate developers and real estate investors. For Nightly Business Report, I'm Robert Frank.